Hi there, thanks for watching everyone. For our latest Artemis Live video interview, I'm delighted to welcome Matt Harrison from Risk Modelling and Analytics Specialist Moody's RMS. So Matt is the Director of Product Management for Cyber at Moody's RMS, and he helps set the strategy on building their cyber risk-focused modelling products and analytical solutions. Matt also spends his time helping insurance-linked securities investors and funds to understand cyber risk as a class of risk they can expand their allocations to. Welcome, Matt. Really good to speak with you today.
You too. Thanks for having me.
So, cyber risk is getting increasingly popular in ILS circles, and we're seeing trading activity picking up. But it's clear to me that more education's needed. So, I wanted to start by asking you about sort of what investors need to consider when it comes to exploring cyber, and perhaps we can start with a brief explanation for our viewers, who are obviously largely ILS sector focused. Broadly, how should they be thinking about cyber risk?
Sure. I think there's always a confusion in my mind of sort of what is cyber risk when we're talking about these products. So to me, there's what is cyber risk, but more importantly, the products that we're seeing, right, are transactions on cyber insurance. So we really need to understand what cyber insurance is. There's a ton of stuff that isn't covered in a cyber insurance policy, and therefore that's not part of the risk that an ILS investor would be taking on board. So to me, we've got to really understand that kind of Venn diagram of overlap. So we're looking at risks to companies, I suppose, but typically it's that intangible risk. What's happening to them when they're hacked? But the physical losses and things like that aren't covered. That's not stuff that we're worried about.
Right. And how do you at RMS attempt to solve for that?
So to me, that's the start place, right? There's no point in me building models that cover stuff that isn't insured. So I'm not going to build this huge comprehensive suite of stuff and waste my time. I really want to be targeted about that. And then when we're thinking about cyber risk, I suppose there's a degree between what types of events can be covered. So there is insurance for both malicious attacks and then also like accidental
Hmm.
fat finger cover. Really, from a model perspective, we try and divide the world into like perils, right? I think sometimes we hear this language about scenarios, and like scenarios are very bespoke things. We've got to think much more holistically, or otherwise we're not covering the whole risk spectrum. So we think about cloud outages, data breach, malware and ransomware and other type of nasties. There's things like DDoS, so attacks against networks,
Hmm.
and each of those we want to build a model that really tries to describe the physics of the system, if that's a sensible way of describing it.
So you build the framework for modeling around sort of those types of perils. And when it comes to constructing that, what sort of data sources are you using?
I mean, I suppose there's two elements to cyber as well, right? We've got the catastrophe risk, but also we have the day-to-day risk. So the day-to-day risk is typically, the attrition, the large loss volatility, which we're not usually seeing going into these transactions. That's more about the data on the events that are happening. But when we're looking at the catastrophe side, we've got to take a different view. We can't, Nat Cat, as though we talk a lot about science, history is a big part of it, right? It's a lot of statistics. We can't use statistics in cyber. What does WannaCry tell me about the world today? It tells me very little other than that kind of thing can happen. So we don't want to use statistical models. So here we're trying to build models that describe the ecosystem. So and that's where the data's coming in, right? It's who are the threat actors? What's their motivation? What's their capability? What's the software look like? The risk is a risk to companies, but it comes about through software. So we need to understand who uses what types of software, what types of vulnerabilities does that software can and will have within it, and therefore how attacks can emerge from that. So we're really trying to, the models come from understanding a digital ecosystem, and that digital ecosystem attacks arise out of that. So if I'm not waffling on too much, a kind of a hurricane model, if we're thinking about climate change, we build a physical model of of the of the world's weather, and we allow hurricanes to be an emergent property of that. For cyber, we're trying to build a kind of physical model of the digital ecosystem, and how do cyber attacks emerge as that's an emergent property of that world. And that way we end up with a kind of an objective ground truth of risk, rather than a frightening expert judgment driven view of risk, where you end up with who's got the biggest expert in the room. And that doesn't strike me as a kind of the objective tools that the markets need to understand risk.
Mm. No, that's really helpful. Thank you, Matt. And I was going to ask you next about sort of how should ILS investors think about these cyber models versus the ones they may be more familiar with, sort of nat cat or life risks? I mean, cyber is still relatively new to the ILS space, and we're only just seeing sort of an uptick in activity now. But so clearly, these are different to the models that they're familiar with, I suppose.
They're different, but I don't think they're miles apart. I mean, I think the point is we're still trying to produce our analytics in a similar way. It's
Mm.
still, can we produce ELTs or YLTs? Can we produce output that is a tractable thing? It's just some of the parts of the models are representative of the peril. And I think the life risk is a really interesting one. We'll probably talk about that later. You know, I think one of the problems that people have with cyber is that sometimes cyber gets labeled as like a peril, whereas in fact there's lots of dynamic things going on within it that are quite different. You know, it's a bit like trying to wrap something up and say, well, that's nat cat. You're like, whoa, 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 I've got exposures in different places. I've got, you know, weather perils, I've got earth perils. There's all sorts of different risks that lie within there, but it doesn't mean we can't break them out. And I think I said it to you before. It's a boring thing. The point of models is that they deal with uncertainty. So
Mm.
though cyber is uncertain, though these models are still new and developing, part of that kind of reflection on uncertainty is something that's inherently considered by them.
Mm. And that uncertainty seems to be the main thing when it comes to cyber and getting ILS investors comfortable with it as well. It's reducing that and making sure that they understand that these models are trying to reduce that uncertainty significantly. Because people seem to focus on the silent events when you see coverage of the cyber market or what could possibly happen to it. But obviously, they're not even hitting the cyber insurance line of business. And as you said at the start, ILS tends to be covering what's included in the cyber insurance line. So, what should investors be concerning themselves about when it comes to cyber?
Yeah, I mean, maybe if I kind of think of this from a peril view,
Mm.
but I mean, I think even, you know, at the start we're talking about we've got these different peril models. I think we can still sort of really there's two dynamics in my mind. You've got you've got attacks that might, you know, if we're thinking at the catastrophe level, we've got attacks that can be at scale, but essentially they're hitting individual companies. And that's kind of what we saw with WannaCry. It's what we saw with NotPetya. And then you've got the other risk that everyone talks about, which is, you know, the cloud outage risk. And they're quite different types of risk with quite different patterns. But really at a systemic level, that's probably all we're really concerned about. There's a lot of stuff that's going to drive the attrition. So if we're looking at things like, I don't know, we'll talk about reinsurance structure. If we're looking at quota share when you're first dollar in, there's lots of things to be worried about. But as soon as you're sitting high enough up, really they're the two perils that are going to drive things. And
Mm.
therefore that's where the attention and focus needs to be.
Yeah, no, that makes a lot of sense. And let's move on and talk about cyber risk transfer and the type of instruments that could be used. What are we seeing that you think is most suited to ILS? Is it those higher layer excess of loss cat bond like sort of return periods?
Yeah, I think so. I mean, like this was a
Mm.
market that started off writing risk XLs as being one of the predominant transfers. That's kind of almost disappeared. The quota share market is obviously still pretty predominant, but again, that's first dollar in, which the ILS market doesn't tend to be as keen on. I mean, the probably the biggest reinsurance product outside of the quote share is more like a stop loss or an aggregate XOL. And really, they're trying to do things like bring in franchise conditions in to make sure that it
Mm,
really is just cat cover that is going into them. Um, there's a sort of an emergence of the occurrence products, but I think the event definition language hasn't really been tied down to make people really comfortable. And I think we're seeing, from a buyer side, you're trying to avoid some of that basis risk where
mm,
if the event definition hasn't been tied down, that's really what's driven the aggregate product. The aggregate product is not, I don't think everyone's saying that that's the what people even necessarily want or the solution. It's just been driving predominantly because of the lack of basis risk. But there's been an inordinate amount of investment in the last 2 years about really trying to tie down what an event might look like and how we define that.
yeah. And I guess the other thing that ILS is going to be important for is capacity, because people are always saying that lack of capacity is one of the things holding back the development of cyber insurance. And people talk about a lack of reinsurance and a lack of retro as well. But how do you think models can help to encourage more capital into the cyberspace?
I think it's giving confidence, isn't it? Really,
Mm,
it's trying to it's giving people confidence that the risk is more well understood and that capital's being used sensibly. I think once we start looking at non-proportional products, that becomes easier as well because we're kind of more constrained by what capital's being given away. The start of the cyber insurance market was like uncapped quota shares, which clearly the ILS market doesn't want to go anywhere near. The sort of almost infinite downside. Models are obviously the convergence of models, the understanding of models means people are more comfortable with what kind of return periods are we talking about, and therefore what the return is going to look like on an investment. But as you say, there is one of the problems for the insurance and reinsurance industry is there is a limited amount of diversification within cyber. So there's only so much diversification that you can find, and therefore that capital has to work harder. It has to be rewarded. And I think that's what the demand is so high for capital to come in to really drive it. But the way that we see it is that it has to pay a risk premium because
mm.
that diversification.
Yeah, yeah, and that's one side, obviously, of the capital equation. But what about investor appetite? I mean, what are you hearing, or what are you seeing, and what do you think might be the best solution to really open up sort of the capital markets to cyber?
Um, I, I think there's a mixture. There's a lot to talk about there, isn't there? I mean, I think people are talking. I mean, it's obviously been an interesting one where probably prior to this year, the cat market was sitting in the doldrums. So
Mm,
cyber was almost like this, the new hope. It's a different thing, but the rates were looking really attractive. So that's obviously driven a lot of interest. But also, it's you know, cat hasn't had the best of time over the last few years as it is. And I think once we look at it, there is a relative diversification between things like credit, how it sits. So if we're looking at other investment classes, there is a diversification there, or at least maybe not a diversification, but not the correlation that everybody worries about. It's clearly totally diversified from nat cat risk, and then the returns have started to look good because the the demand is so high for capital that capital can kind of walk the talk and demand the price that it wants.
yeah, there's a question over when people are going to actually find a price for cyber risk that's going to be a stable level of buying for corporate buyers out there. It seems to be moving very fast at the moment. So if we think about the potential for cyber cat bonds, now obviously we've seen one transaction that's being called a cat bond, and I hear there's others potentially in the works. But how do you at RMS envisage a cyber cat bond being structured?
I mean, I think, a lot of the stuff that we've seen has been on an indemnity basis, or a lot of the conversation has been. And I think there's a mixture of appetite, there's a mixture of demand. I suppose there's two models, isn't there, really? One is, if you look at cat, it's actually been a big part, ILS has been a big part of the retro market. And if it follows that, I suppose, which is I'm kind of personally keen, because I feel as though if we had a good retro market, that itself unlocks more reinsurance, which in itself unlocks much more insurance, and we need that kind of pyramid of risk transfer. We've clearly, for all of the kind of concerns, we've been really interested in. I've been very interested in sort of ILW transactions. I think that's sort of, yes, there's basis risk in it, but we can sit at a level that removes some of that, and I think it reduces some of the other basis risk. I suppose, to me, it goes back to these underlying phenomena. If we've got this kind of cloud outage versus malware, we kind of see it as, we've heard a lot of people talking about parametric products. Parametric mirrors really nicely to the kind of cloud outage peril. The problem is then probably from the buyer side, that actually the risk that we see that's the bigger risk is more the malware and ransomware. My kind of bad nat cat comparison, how I tend to think of it, is we tend to think of cloud outage being more like a Pacific Northwest earthquake. This is the 1 in 10,000. That's a big event. That's scary. But actually, the 1 in 200 is almost like nothing's happening. The threat actor motivation, the threat actor capability, and the likelihood of one of the big cloud providers having a vulnerability that can be exploited to cause these big outages. Those things are just all so unlikely that we just see that frequency as being really, really low. Severities can be very high, but frequency is really low. If you look at that kind of malware, ransomware type risk, the WannaCrys and the non-pettiers, we've had 2 or 3 years of misfactors. Large software companies are constantly disclosing, we got this vulnerability. To me, it's like a hurricane that's spinning out into the mid-Atlantic and just doesn't make landfall anywhere. There's a potential, but actually there's no real loss. And we can understand that. There's lots of data around that. So again, yeah, I've kind of half alluded to it. I feel as though that malware, ransomware risk is one that is more like hurricane. We have frequency, we have severity. So to me, though, it's the quasi-parametric nature of cloud makes that feel like an easier product. Actually, the demand is more on that malware, ransomware side, where it probably is something that we need to learn the lessons of life and those types of transactions. This is something that spreads, it propagates like a virus does.
Mm. Yeah, and it's interesting because the cloud outage product seems something that's very suited to corporate buyers, but potentially they're not going to be big enough to be wanting ILS capital, and really we need that marketplace to develop before somebody would be hedging that risk significantly, I suppose.
If it's one of those ones that there are obviously people out there who are looking to provide that as a bespoke insurance product, and then you have this kind of back-to-back consensus of risk through the value chain. So if that becomes a big product, then I think there is minimal basis risk for anyone, and it's a great fit. I think at the moment, where you have the cyber insurance product, it often doesn't cover or doesn't cover to the same level accidental outages, which is what the history of all the outages we've seen. It focuses on malicious. So you end up with this basis risk on how do you even measure which one it was. Whereas if you're just providing cloud outage, which there's a few products out there, it's a ubiquitous product. So you have this back-to-back view of it. You reduce the basis risk for all. I just think the malware and the ransomware is the bigger problem for the majority.
Yeah, no, it's interesting. So I thought one of the things you've mentioned a few times is around event definition, and it would be interesting to hear how you view this at Moody's RMS within the context of cyber risk and ILS. So for cat bonds and the like, I mean, is event definition going to be really critical? Is it something that you think is going to just be constantly evolving as new threats appear?
I think it's the problem is, again, it always goes back to language and being boring, right? Cloud outage kind of marries nicely.
Mm,
Event, typically we think of time and place, and cloud typically mirrors that, right? We have an event happens at a location. Whereas when we're thinking about that sort of malware type risk, you look at WannaCry, NHS was hit, and then probably the next company that might have been hit was the other side of the world. So time and place are fuzzy, which is where, we either need to think about, hours clauses have always been a problem. I suppose
mm,
our view is when the market comes up with a problem, we can mirror the language relatively easy. We can understand how these things spread. We can understand the temporal patterns of it. But unless the market has a certainty of what it's covering, we can build a model that covers all of those things. It's going to just produce so much data. It's almost too unwieldy to be usable. So, I mean, whether it follows something more like how the life market has gone down, or we go for almost a standardized hours clause, that's an easy thing for us to then go and mirror. Or we go for something like PCS, which is almost just name it and have it with aggregate within a year. There's lots of ways that we can do it. It's what are people comfortable with, and what gets accepted, and then we can mirror that pretty easily and pretty quickly.
sure. And I guess what mirrors the protection buyer's real needs as well. One final question for you, Matt. And this is for personal interest. What's your view on artificial intelligence and the current wave of development there, and how that
Oh,
plays into the cyber threat sort of world?
oh, it's pretty terrifying, isn't it? I at the moment, I think I say with most of these things, what tends to happen is for an insurance risk, I'm not particularly worried because risks constantly are changing as they are.
Mm,
But at the same time, though they're constantly changing, for a risk vector, that they sit within families, right? If you look at who's carrying out what attacks and why, the majority of it is people are looking to monetize things.
yeah,
So, and there's only so many ways that you can monetize. I can steal stuff and sell it. I can force you to send me money, and or I can blackmail you to get me money. Well, all of those things are kind of risks that are already out there. So AI just, dials up certain elements of that, but we react to them. I mean, the
mm,
one that people have talked about the most is like funds transfer fraud. If you can produce videos of your CEO saying, please wire £1 million to this account. Well, from a corporate perspective, you have protections in place that stop you doing that in any case. So there's a lot of mitigants to that risk. Same strip, like we could talk about quantum and all these other things that are coming,
sure.
but most of the time, the risk feels as though it's a big step change, but really it's more of a gradual change, and we adapt to those gradual changes quickly. So
Mm.
yeah,
And I guess
terrifying.
with things adapting fast on that side of the threat spectrum, you're also going to see cyber protection tools adapting very quickly as well, and AI playing into that.
Exactly. There are innumerable protective companies who say that they use AI technology already,
Mm,
and as you say, it's a kind of a cat and mouse war. But the the bad guys can never get too far ahead, really,
mm,
because their ability to weaponize just isn't there. And again, they're after money. So there's only so much money. There's only so much they can do because the financial systems stop them going too far. So Yeah, it sounds scary, but really, I don't. It's not the thing that's going to give me sleepless nights. That's for sure.
Okay, that's good to hear. Well, look, thank you very much for your time, Matt. It's really good to talk with you today.
You too. Thanks, Steve.